Keynes, like Buffett, would pick those companies that he really liked, those stocks he really liked. He called them his pets, by the way. He'd pick his pets and then he would hold on to those through thick and thin, through the ups and downs of the market. The popular consensus that has grown up around Keynes is that he was a fantastic investor. Well, whilst we have not exploded that story, so our overall conclusion is that he performed very well for his college, it is a more nuanced story than this popular view that previously existed. Keynes ran money for himself, for his college, as well as one or two other investment institutions, including a fairly large insurance company where he was a chairman. And he resigned from that position in 1938 because he could no longer stand the criticism that he was receiving from other members on the board. From 1924 up until the early 1930s, he didn't do as well as he thought he probably should have done. And actually for a period of several years, he lagged the market. This caused him to have to make some changes in the way that he managed his portfolio, quite significant changes, which he did talk about in his correspondence later on in life. After that change, which took place in the early 1930s, then he really started to perform very well. As an economist and someone who was a big consumer of economic and industrial statistics, he thought he could predict the business cycle effectively, and therefore he would know when to be in the stock market and when to come out of the stock market and be in cash or in bonds. So this is what we call a top-down or a market timing approach, where you're trying to time moving into and out of the market. Well, he failed to pick the sharp decline in the London market along with Wall Street in 1929, that was the onset then of the Great Depression in the United States. So that was a great disappointment to him. It was then in the early 1930s that he completely switched away from this top-down approach to more of what we call a bottom-up approach that's practiced by someone like Warren Buffett, i.e. Keynes, like Buffett, would pick those companies that he really liked, those stocks he really liked. He called them his pets, by the way. He'd pick his pets and then he would hold on to those through thick and thin, through the ups and downs of the market. And that is what served him so well through the 1930s and up to his death in 1946. In 1937-38, there was a very sharp fall in both the London and the US markets. Again, at the beginning of World War II, the market sold off very, very sharply. And the prices of these stocks that he liked were falling, but he held on. In some cases, he bought more of these companies. And he was able to do that because he was running money for his college. His fellows trusted him in what he was doing, and he had a particular organizational setup, which I think was very conducive to the way that he was running money. Today, it's not always easy to be able to achieve those sorts of things because you are surrounded by other investment managers or other people on the investment committee who can sometimes take a very critical view of what you're doing. Keynes's incentives were highly aligned with those of his college. His interests were very much those of growing the wealth of the college and the size of the fund. And therefore the other members of the college fellows and the investment committee did trust him in what he was doing. However, and you would find that situation exists in some institutions today. However, I think what is different is today it's likely that there would be other experts who sit on an investment committee who possibly, from what I can understand, probably were not sitting on the investment committee in Keynes's time. Because of his extensive social network and because he had such good contacts, there were times that he would have been in receipt of should we say, good information or semi-private information that he would have been able to trade on. I think the other thing I would say is that he had quite a high moral view of the way that you should invest, and I think he would have very much have disagreed with an insider trading type of strategy from on moral grounds. He just didn't think it was the right way to play the game. The way that he invested in the second half of his investment career, I think, is one that has an awful lot of merit, yes. Part of the problem with his this so-called top-down approach, where he was moving in and out of markets, there are two problems with that. One is that you incur an awful lot of transaction costs, commissions and other costs of trading when you're pursuing that type of approach, and that eats into your returns. The other problem you have is, obviously, you have to be absolutely right in your timing of when you move in and out, and those are not always easy things to be able to do. So I would commend particularly to private investors, but even to some institutions, this alternative approach of buying and holding stocks and investments that you really like. Of course, his big insight in the 1930s when he wrote the general theory was that he realized that there was nothing automatic about the ability of an economy to recover from a shock such as the Great Depression in the United States, and that it's possible in the absence of sufficient demand for an economy to get locked into this very sort of low activity equilibrium. So I think the thing that would worry him most today in the developed world is still the lack of demand, of aggregate demand that's out there from consumers and also from firms in terms of investing. And so all his focus would be, I think, on thinking of ways to try and stimulate aggregate demand to get the economy moving. The other thing I think that really would have deeply concerned him is the behaviour of some financial institutions through the last financial crisis. As I said, he had quite a high moral view of the way that this business should be conducted. In many ways, he regarded investment as what he called a very low pursuit, and I think he would have been somewhat appalled at some of the things that have taken place, and I think he would very much be on the tracks of, well, how do we try and improve institutional behaviour, and how do we make sure that things such as this last financial crisis do not occur again.